Despite inflation hitting a new 40-year high. Bank of America's credit and debit card spending was up 15% in early April compared to the same time last year. Joining us right now in this Fox Business exclusive is the CEO of Bank of America and Chairman Brian Moynihan. Brian, it's great to see you.
It's great to be here. It's good to see you back in the studio after a long time.
Yeah, you're right. It's true. Thank you so much. And that long COVID period, I guess, was a period where people were socking away money and increasing their wherewithal to be able to spend. Walk us through what you've got here, these good, positive signs of the consumer. What are you seeing in terms of spending?
So if you think about the U.S. consumer, you got to think about two ways. The spending, the volume of what they spend, and also what they have in their accounts and what they have to spend. And so in the first, during the month of April, you said 15%. Actually, as of last week, which is a week later in the data you had, it's up 18 to 20%. The first quarter's up 13%, sort of fairly stated. What does that mean? People are doing more. What's interesting about it, and I heard a segment earlier, is they're spending on travel. Travel bookings year over year, like 70, 80%, January, February, March, and into April. That doesn't mean they've taken the trip yet. It means they had to book the trip, and people are racing to get the capacity to do it. They're spending it on other services. When you go to the account side, a person who had $1,000 to $2,000 of average balance in an account pre-pandemic is now sitting with $7,000 in an account. A person who had $3,000 to $5,000 is now sitting with $13,000 in an account. That's going to be very interesting because when the last rate rising cycle, the consumers didn't have that much cash sitting around. And then the other thing is consumers have capacity to borrow. Home equity has risen dramatically. They can borrow against that. Credit card balances for us are still down 20%, meaning they have the capacity to borrow that. The lines are still out there. People just aren't using them. So that's going to be an interesting thing to take on for the Fed as they raise rates. How does all this cash and capacity in the spending power and this pent-up demand drive the consumer side while you have shortages and other things on the commercial side?
Yeah, I mean, that's the question, right? Federal Reserve Chairman Jay Powell says the 50 basis point hike is likely in the next meeting. That is in May. And then we're expecting a string of further hikes. What does that do to the consumer's capacity, willingness to keep up this spending? And I love the fact that you are saying they're spending on travel because that's what I'm seeing anecdotally. They're spending less on stuff, but more on services.
Right.
Does this higher rate hike environment put a damper on that?
Well, ultimately, things like housing, they have to slow down housing up 20% year over year. That is not a healthy
5% mortgage rates.
Rate. So that'll slow down in terms of things. But again, there's a lack of housing, so there's demand. And so these are going to be interesting and more ticklish times, I think, than in the past when it was sort of raise the rates and instantaneously saw the transmission. I think people have to step back and think about it. The sort of base assumption that Michael Hart and the team have for us, I think it's 50 basis point rise. A 50 basis point rise at a meeting is unusual. To think that our experts are saying 3 in a row. The Fed knows they got a job to do to tackle inflation, and the question is what happens on the other side of that.
Yeah.
And that's one of the tricky executions. And again, the debate is a recession on the other side? Our people don't think so. They had this year's growth at 3% plus, next year's growth just under 2, which would be under the long-term trend. They don't see the recession, but that doesn't mean it'll be perfectly aligned to inflation coming to check. And behind that, wage growth is strong, and labor shortages are strong. So there's a lot of dynamics going on, and then obviously businesses are still struggling getting things to sell, cars, and just struggling, and that means there's pent-up demand, which will lengthen this cycle. So we're fairly optimistic in that we believe growth in the next couple of years as a company, and everything we see supports that.
So do you think we'll see a recession this year or no?
I don't think so. Not this. I mean, it's got to be 2 quarters, and you're almost through 2, and it hasn't happened yet. So let's just. So the idea is it'll be out there. But, this was, if you think about the cycle, we had the longest recovery cycle leading into the pandemic. The pandemic changed everything. You had a recession. But the reality is if you really step back and said the federal government, Congress, and administration pushed so much money in, they actually spackled over the recession. Yeah. So potentially you could view this as we're still in this long recovery cycle from the financial crisis. Yeah. And that it got interrupted by this moment in time. And now the question is, what's the geopolitical risk? What's the Europe risk and the growth and things like that? Because that's where the next round comes from. Food issues, Europe growth issues, China issues, the things you were talking about, shutdowns. That all could impact the ability for the U.S. to keep growing. But the U.S. is the place to be right now.
So what's the impact on BofA? I mean, I want to get back to wage growth because this is such a key point for so many companies. And here we are in the middle of earnings season. But you've got a securities book carried a fair value at $300 billion or something. Yeah. What happens as rates go higher? And does BofA benefit as rates go higher?
Well, we benefit as rates go higher because for the last several years, and most of my time as CEO, the Fed funds rate's been effectively zero, and so we hit what we call zero floors. So we don't give a customer a negative interest rate, even though the real interest rate that we should be giving them would be negative.
That's huge. People need to understand.
So we stop at zero. So as the rates come back up, we gather back in that advantage and that value, and that has been taken out of our P&L. The way to think about that is our net interest margin as a percent, which runs around 2.5, 230, 240, 250, ran down to like 160, 170. That difference is a squeeze on the floors. So when rates rise, we get that back. And now, the good news is when rates fall, obviously deposit and accommodation came in, deposit balances went from $1.4 trillion to $2 trillion over the last few years.
Yeah.
And that, growth year over year of 13% or something like that, it shows the power of our franchise, but also that, you'd expect that growth rate now will mitigate as accommodation stops.
So let's talk wage growth. This is one of the big expenses and I know you're spending a lot of money on technology, you're spending money on cyber. The company made $7.1 billion in the quarter. What was the component of wage growth, and what are you expecting in terms of your expenses?
Well, we had about $59–60 billion in expenses in last year, and we said for people to expect relatively flat. Year over year, we're actually down a little bit in expenses. So we're managing the heck out of the operational platform, what we call operational excellence, efficiency and effectiveness, deploying technology, following the trend on consumer behavior changes that results in a more efficient way to serve them through digitization. But, wages are growing strong in our company. It have been for years, frankly. We put in our annual report this year, we tracked cohorts of people who've worked in our company 10 years, 9 years, et cetera. You track them across time, and the wage earners, say below 7,500,000, have experienced basically double-digit wage growth per year for the last 12, 13 years.
And let me just point out, you were the first to come out back years ago and raise the minimum wage.
Yeah, we went to 15, and now we went to 20, and now we have a commitment to 25. But the reality is that's a starting wage, which is a great starting wage. Think about a person coming to work for us basically starts nearly $45,000 to $50,000 with full benefits. The health care cost of, for an individual, a couple $100, $125 a month or something like that. For a family, $250 a month. We try to provide a great group of benefits. One of the things I'm proud of is our teammates had $20 million in tuition assistance last year.
Oh, wow.
That we gave them,
nice.
Which was good. And so this is a great place to work, and that's one of our strategies. We have 208,000 people do a great job, and we have to have the talent, and the talent's tight out there.
Yeah.
And on the other hand, the policies have kept our turnover more manageable than I've seen in the market.
So what are you expecting in terms of expenses this year, going into next year?
Relatively flat. We had an inflection point back before the pandemic where we had years and years and years of declining expenses. We just couldn't do that anymore because inflation caught up with it. We're basically going to operate this year on the same expense base we probably operated in 2015 or 16. Think about that.
Wow, that's huge.
And that's all through effectiveness of the team. Now,
well, that's all leadership, Brian Moynihan leadership, okay? Because since you walked in the door, I got to give this to you, Brian. Since you walked in the door, you've completely turned this company around. Going into it, people were like, wait, he's a lawyer. What's going on? How is he going to run the largest bank, one of the largest banks globally? And you did it with ease and leadership and strength. Congratulations. You deserve it.
Really, the team did a great job, and the shareholders have benefited, and employees have benefited, the communities benefit. They do a great job, and they do it the right way, and that's what we're all proud of.
What's going on with the stock? Down 18% year to date. Why?
It's this fear of recession and impact on credit. So, oddly enough, at a time when bank stocks would be performing well, when we up 47% or whatever it was last year, and then we were kind of up coming into it, as the Russia invaded Ukraine, and people said, "Oh my gosh, we could have." That kind of risk on top of the need for Fed to take out the accommodation. What's happened is the belief is, can you tame inflation without a recession? And that's impacted us. But meanwhile, we earned $7 billion plus last quarter, and the company's doing very well. So if the stock is down, we'll buy it. Then it's cheaper. Yeah.
All right. So let me ask you about the lines of business. I want to get into mortgages. I'm going to wait till the next segment and talk to you about what's going on with the mortgage business with these 5% rates. But what about capital markets? I mean, this market has been so nervous. Do you worry that it's scaring investors out altogether?
Well, you can see the underwriting activity in the first quarter industry-wide, I think, was down 40%. We were down a little bit less. We gained a little market share. So that's underwriting bonds and equities. That just was a freeze up in the market until you get stability and price stability, and then you can go on from there, especially on the fixed income side. Think about there's a 100 basis point rate rise in some of these rate structures in a quarter. I mean, these are unprecedented moves. So you take mortgages up, what they call CMM, which is the mortgages you buy the rate at. You think of that as up 100 plus basis points in the quarter. That's on a 10-year instrument. Think about the hit people taken. So, that'll even out and quit moving as much. But that chilled the markets. Now, the good news is the team gained market. And trading, we did fine in the first half. Record equities volume, because as the volatility came, people moved it. And Jimmy DeMar and the team do a great job there, and Matthew Coder on the investment banking side. But the reality is the markets have got to kind of get through the transition where the Fed has raised rates enough people believe they can get inflation check, and stability comes in, and hopefully we see a mitigation of the situation in Europe. But all that uncertainty, the markets, the idea of our stock moving up and down 1% a day is, with a $300 billion market cap, that's just unusual.
Yeah, Brian, let's take a short break. We have more to get into. We're talking with Brian Moynihan. I know that the capital markets is something that has been front and center. We want to get more about what you're expecting for the rest of the year. Oh, and by the way, you're one of Elon Musk's bankers. Brian Moynihan is next. Stay with us. Welcome back, and we are back with the Chairman and CEO of Bank of America, Brian Moynihan. Brian, you had a great quarter that you reported a few weeks ago. Let me get your take on lines of business and where the strength is coming from. I want to get into small business, because small business is a big portion of our audience. But what drove the quarter? Let's go broad.
Well, all the businesses performed pretty well, other than the investment banking. But even in that business, which is large corporate banking, lending, and GTS, we actually had good growth overall. So we had operating leverage in 3 out of the 4 businesses. But the consumer side drives it in small businesses, and then we go back there in terms of earned $3 billion after tax, our consumer business alone last quarter, and Dean Athanasian and the team that drive that do a great job. We saw good the start of stabilization and some loan growth on the consumer side, which is different because the mortgage have been running off with a low rate structure.
It was slow coming back, loan growth for the industry.
On the consumer side. Yeah. For us, we had $50 billion in the fourth quarter. We had we had 10% year-over-year growth in the first quarter compared to first quarter last year. We've been making progress. We told people we're making progress. First quarter last year, second quarter, they thought we were nuts, and then you saw it come through. And
well, it was organic growth.
It's all organic. Yeah. We don't acquire anything. Wealth management business had a great year. Operating leverage, revenue up year over year compared to peers. I think that's better. Good loan growth, good deposit growth, and so all the businesses are doing well and gaining market share. And my job is to make sure they have the resource and the capability, the technology spend, the structure around them, make them work. And then one of the things we do is get them to work together. And we have 92 market presidents. Jose Tavares here in New York, and many other around the country, and they get the team to work together in support of our customers in our communities to really work it, and they do a good job doing that.
I was surprised to see what went on with Zelle. Talk about technology and how you've invested so much in tech and how people have adapted at this point. But Zelle had a very strong performance. It's like the first time that we actually saw a real breakout there. Is that right?
Well, I think what's happening is people are getting more and more used to these other different payment systems. So but Zelle basically, is an industry-wide platform, so you can move money from bank A to bank B through your mobile app and stuff, and that grew. And the interesting thing about it is people initiated more transactions with Zelle than they wrote checks. And so checks are down about 20-odd%, 25-30% from pre-pandemic. The dollar volume is actually up, which means people are reserving checks for larger payments. And the small stuff, they're starting to use Zelle and other means to pay, which is good because it just allows things to move faster and better. And so on technology overall, even in our wealth management business, the pandemic, probably moved us 3 to 5 years ahead on the adoption of digital engagement with our customers. So the financial advisors and private bankers have a deep personal relationship. It is high touch. It is carefully crafted for every customer. And they do a great job at Merrill and the private bank doing that. But the reality is, to sign papers with my team, I just had some stuff I had to sign, to be able to do it all electronically is so much more effective and efficient. Yeah. And that was going on at like 5, 10%, 15%, 20% pre-pandemic. Now it's up 75, 80%. that makes the whole system more efficient, but it was the platform we built to allow that to happen. And so you take, and then on the commercial side, the Cash Pro, which is, people can make payments through a digital app type of thing, corporate treasurers, and those numbers are going through the roof. And so everybody sees a consumer, Zelle, Erica, the mobile banking, 54 million digital customers, 40-odd million active, 35 million checking accounts growing, wow. All these things happening, but they forget this digital impact is across the whole platform.
Yeah. Hey, Elon Musk chose Bank of America as one of its banks to do this deal. Is it good for the money? I mean, what can you tell us?
I don't think we can talk about client stuff, so I'll let you speculate on that.
But this is, are you surprised at the excitement around this deal?
It's been fascinating to watch all you guys in the media be fascinated by this, I'd say.
All right, Brian, it's great to have you.
Good to be here.
Thanks very much. Brian Moynihan is the Chairman and CEO at Bank of America.